Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. And today, I've got a very interesting one for you. I'm finally releasing this out to more people other than just kind of a private group. So I'm going to talk about a potential, actually, technically an infinite return on investment because I have a way where I've gotten my entry cost to this thing down to zero. It's a little complicated to explain, but it is in the Maverick Life Premium Substack, which you can check out with a free trial in the link that will be in the description. There's a potential 35% return on investment if a particular company goes bankrupt. So here's a scene from The Big Short with Chapman, Scarborough, and my very handsome, aesthetically pleasing visages photoshopped in there. It's a short position that he and I both have against Seagate. Okay, so full disclosure, I do have a vested interest in this particular theme, and he and I are going to be talking about this next week. So stay tuned for that. Disclaimer: nothing I say is intended to be, nor does it constitute investment advice. This is just my opinion. It's what I'm doing. And caveat emptor, anything you do is your responsibility, your decision. This is just one man sharing his thoughts on his on his work with the world as kind of a diary. Think of it as a journal entry, nothing more. All right. So the publication that I mentioned, the Maverick Life, it's a publication project where I show you one of the sources of income, geographically independent income, that is really the key that allows me to live what I call the Maverick Life. And it's just my philosophy on how I want to live. I want to live where I want to live, when I want to live, and what I want. And guess what? You need to be able to have something that allows you to do that. You need to have the financial resources. And so this is one way that I share with you something that has been life-changing for me. It's me taking a certain amount of money that most people can relate to, just a middle class savings, and how I am hopefully able to generate the returns that I have and continue to generate that into the future to generate an upper class level of income from that basic middle class starting capital. So I share every single trade that I make, all the screenshots of the portfolio. You can check that out for a free trial, link in the description. It's very exciting, and I hope that you're excited about that too. For those of you that don't want anything to do with options, fair enough. I also run a portfolio on etoro. You can check that out. Link will be in the description. Also, it's just a pure and simple value portfolio, 24.97% return year to date. Obviously, I can't guarantee anything, let alone past performance and all that sort of stuff is no indication of future performance. But if you notice here the volatility, if you're okay with that because you agree with the value thesis, then perhaps you want to check it out, and you could, in theory at least, copy the portfolio if you wanted to. Okay, let's get into the meat of today's discussion, which is asymmetry in action. A small definable amount of capital, so you know how much you're going to put in, you know exactly how much you could lose if the whole thing blew up, with the potential for asymmetric multiple returns, okay, or an anti-fragile event if you're a fan of Nassim Taleb. So here's a screenshot from the publication, The Maverick Life. It's an article that I've shared with the members. It's me buying what I believe to be undervalued insurance with a 35x potential payoff. In that article, I go through the whole nuts and bolts of it, so you can check that out if you're interested in learning more. The short thesis on this particular company in a one page is this. So Seagate sells stuff, right? They sell hard drive memories, those sorts of things. Their business is becoming obsolete with various technological changes. That's the thing with technology, it changes rapidly. So the company over the last 3 years had a front-end demand event where COVID led them to sell more. Then they hit some hard times. The sales started slowing. Their inventory is rising, and that's how you know they're not moving their product. The inventory continues to rise, and yet the stock price kept going up. So what the hell was going on? Well, what happened was, as far as I can tell, this company has borrowed to the hilt. Like they have really borrowed something like 8 times their EBITDA to maintain the dividend and to buy back their stock. And so that's allowed them to kind of maintain this facade. They've been buying back their stock, paying out dividends. Shareholders are all happy. They got no idea how they're doing it. They don't care. But there's a big problem. they eventually run out of the means with which to pay these dividends. And that is that you have to actually make some money, you have to make some free cash flow. And out of that is what you should be paying your dividends. You should not be going, in my opinion, the way I would run a company, the way I have run companies, is I don't go and borrow to pay a dividend. I go and maximize the free cash. And out of that, we can pay dividends if that's the particular strategy. So eventually, the lenders that have lent them this money have said, "Hey, like, what's going on? Why are you paying yourselves all these dividends? Why are you buying back stock? And we're really not comfortable with your cash balance." The company wanted to refinance, and so eventually, after I think it was like the Sixth Amendment to their debt agreements, the company was forced to agree to a covenant which requires them, as far as I can tell, and Chapman knows a lot more about this than I do, they're required to have 700 million in cash on hand. And if they want to pay a dividend, that number's got to rise. They've got to boost that to 800 million to be able to pay out that dividend. The leverage ratio must also stay less than 6.75. It's not technically net debt to EBITDA. It's like some weird, as far as I could tell, bullshit calculation about like EBITDA adjusted or agreed metric. It's pretty vague, to be honest. But I think that smells quite fishy. In any case, if they breach these kind of covenants, they're going to be in big trouble. They're going to have credit events. They're going to signal into cascading default clauses, and they're going to really be in trouble from a liquidity perspective. The company has had to refinance several times, which I mentioned. In my humble opinion, the game is really coming up. If you check out Chapman's work, I highly recommend his Substack. I will leave the link in the description. His models go through where the company's cash currently stands. And as far as I can make out, the end of this quarter this year, if they want to fully draw down their revolver and then continue to go the way that they're going and pay out these dividend events, they're going to be way short of both the leverage ratio requirement and this cash on hand requirement. So here I come up with this idea. I personally believe this company is in big, 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 big trouble. So the way that I think is I say, what if I could trade insurance on this thing going bankrupt? If I think there's a good chance it's going bankrupt, the next question is there an asymmetric payoff there? And there, in my opinion, there is. So check out the publication and I'll run you through it. Here's something that was taken from the article that I wrote. Okay, so here you can see net income in the blue. Not good. We wanted to, we would normally want that for a company to be above the zero line. They are not making a lot of money. They're losing quite a lot of money hand over fist. Changes in accounts receivable. So if they say, oh, well, we've got all these orders coming in, technically year on year, that's gone up. But that's certainly nothing to brag about. They're changing inventories. Look at that. They're going up, slight decrease for 2023 in the first quarter, and then they've increased again in June. Their sales are struggling, okay? And if you're looking for cash flow per share, the reason you can't find it is because it's not there. All right, there's just it's a myth. Let's take a look at some things I want to point out from the one pager. So I've been short the company when they're about $70. They've dropped down, they come up again. It's one of those things. At the time of recording, they're $65.37. A few things to point out. Their net debt to EBITDA is 8.8 times. If you're a creditor, normally you won't accept that. You want that ratio to be less than 3. Any more than 3, and you're really pushing it, unless they've got a very good plan to be able to pay that down. Okay. Their price to earnings multiple is currently at $87.41 times. So for every dollar of earnings, you're paying 87.41. That requires an enormous amount of growth to be to be able to make that justifiable. And I don't see it happening in a company that sells outdated hardware. That's just me. Free cash flow yield is not much. Payout ratio is 110%. What does that mean? They're paying out more than they earn in a dividend. Okay. So if I'm paying you a dividend and I earn $100 a year and I pay you $110, you're going to be happy because you get $110. But surely eventually you're going to start to ask questions. Well, Ben, how are you continuing to pay this thing when you only earn $100 a year? Okay. And this is kind of the situation that the company, in which the company finds itself. Okie doke. Here's another little trick. Return on equity looks amazing, right? 97% return on equity. But that's purely because this company is so jacked up to the gills with debt. Then it really alters the equation. The earnings has been declining at a rate of 66.3% compounded over the last 3 years. Terrible. Short interest, and this is another key thing. You don't want to make the GameStop mistake. Short interest apparently is only at 5.9%. So it's fairly low still for a company this particular size. All right, sticking with the valuation over the last 3 years when things really have gone pear-shaped. So what do we want to see here? Basically, the green line is going down. That's its free cash flow yield. Okay, the company's not making any cash. And then if we look at their price to earnings, which I mentioned before, that's the blue line going through the roof here. Okay, so not good. You're paying more for less. That's all well and good. It's easy to identify a company that's overvalued, but one of the most frustrating things is identifying something that's overvalued, shorting it, and watching the thing take off. Okay. And it's happened to me a couple of times. And so I really short unless it's a liquidity event. And I think that this could well be one of those. So, what makes it a short? Just because it's overvalued doesn't make it a short. I think what makes this a short are the series of events, the handcuffs around this particular company. The liquidity is cooked, as we say in Australia. Let's take a look. Their cash equivalents ending first half of this year, 30th of June, 786. They're getting very close to that covenant level of 700 already. At this level, they're not supposed to pay out a dividend. If we go through and we look at their accounts payable and their accrued expenses, okay, as far as I can tell, most accounting rules require this accounts payable that's counting those accounts due within the next 12 months. So if we look at what's on their balance sheet, they got 786 mil. They got to pay out 1.6 billion in accounts payable over the next year. That's a lot of hardware they have not been selling to make up for that. In addition to which, they have their accrued expenses. Their accounts receivable is basically nothing, okay, compared to their accrued expenses. So their accounts receivable might cancel out their accrued expenses, but nothing more. You still got this big 1.6 account payable. If you look at their total liabilities, current liabilities, so those due within the next 12 months, they're a whopping, rounded up to 2.6 billion, where their total cash and short-term investments, so maybe they've got some bonds or who knows what, 808 million. Okay. I don't, if I was their banker, if I was their creditor, I'd be pretty worried. I don't have confidence given the fact that they're not selling much. Let's take a look at the cash flow statement in an illustrative form. So, cash equivalents, the green. Where's it going? It's going down. Okay, not good. And all else being equal, not good. Okay, sometimes it can be good if they're paying out true earned dividends and all that sort of thing, but that's not what this company's been doing. They've been issuing debt here, okay, in the pink to be able to pay out dividends, which is why their cash is eventually going down, adding to the fact that they've got to keep servicing debt at high interest rates. The cash equivalent at the end, okay, so start and end green, orange, green, orange, green, orange, always going down. The cash at the end has gone up a little bit because they've been able to obtain some liquidity from debt, and they're looking to issue notes, which I think will make it a toxic position in which to find yourself. If I were a shareholder, the last thing you want to be is be diluted to the hill. We'll talk about that in a moment. It's just a pure basic rolling graph of their debt. Okay, it's going up. Okay, it's gone up a long way, way more than where it should have been. If we take another very good measure of liquidity, which is the quick ratio, it's better than the current ratio because it shows purely liquid ways of paying out their debt. The current ratio often takes into account some inventory, but if they haven't been able to sell their inventory, even with heavy discounts, as I understand it from the retail market, They can have a fire sale and they still may not be able to clear much of that inventory. It might not be worth much. They might not be able to give it away if it's outdated tech. Who knows? But so far, they haven't been able to sell it. It's below one. Okay, bad. Uh, you look at all their current liabilities. How much liquidity do they have to pay those current liabilities? It should be at least above one. Okay, to be comfortable, and they're a long way short of that. All right, here's I guess, a news montage. Sharing, I know Chapman won't mind this, is sharing a few little DMs here. Yesterday I got very excited. I was DMing him saying, yeah, it's happening. Um, so what was that all about? We had Seagate, the CEO, sells a heap of shares. So he sold 21.3 million shares. I believe that was half of his holdings. And their second largest shareholder also sold half of their holdings, and as I understand it, and they're looking to issue 1.3 billion of unsecured notes. In other words, what they're trying to do is dilute the hell out of the shareholders, raise more capital. That way, they're going to take that and pay down some of their debt so that they can hit their liquidity mark and stay alive. I don't know what's going to happen with this. It's a question. It could mess up my thesis. I don't understand why someone would buy these notes, because they're being issued at 3.5% interest and then a convertible. I don't get it. The US 10-year you're getting, or T bills you're getting like 4.5, even 5% return with no risk in 0 to 30 days. Who is going to buy these notes? I don't know. Just because I don't know doesn't mean there isn't someone silly enough to do it. That's another question. But I I'm just trying to think of ways where this thesis may be getting messed up, and I haven't found anything convincing. Maybe it slows the sell off, and so I get to the expiry date on some of my insurance contracts, and I have to roll them out further. But gee, I don't know. I just don't see it. If anyone's got other ideas, drop them in the comments section. So potential hiccups. They draw down the revolver. Does that extend things to December? Doesn't bother me. I've got longer dated insurance contracts. Um, do the notes provide some relief? Again, as I mentioned, 3.5% interest is an offer. Like, who's going to pay? I don't understand it. Who would be silly enough to pay that? And how much relief will it give them? And when they dilute that, what will it do to their share price? So their market cap will go up because there's more shares. But if you dilute the shareholder base by 100%, will that half the stock price? I mean, I'll still do very, very well in that scenario. It's hard to figure out for me at the moment where this is going to mess up. Another question that I had, and I asked Chapman about this, was, what happens if someone just comes in and buys them? Their competitors do have a decent amount of cash. But then his response was also, well, who would want to buy them? Like, why wouldn't they just let their competitor go bankrupt, let them die on the vine, take their customers, when they're going to be paying like a ridiculous amount to take over the entire company, because they'll have to buy out the debt as well. So, yeah, as far as I can tell, I don't know. I think it's worth a shot, or a short in this case. So it was around about here where I started entering my shorts, and I continued to average as the value of these contracts went down. As the stock price was going up, the stock prices just shot down again. If we hit this 200-day moving average of $60, then the algorithms will jump on the feed and start to attack it, hopefully, as we've seen here. Yeah, so we'll keep it. Well, I guess we'll keep an eye on it. So that's that. If Seagate goes bankrupt, I'm going to be very, 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 very happy, man. So yeah, there's that. I don't mean to be ghoulish, but I do stand to make a lot of money. It's not my fault. I wasn't in the management team taking on all this stupid debt and doing silly things with it. So someone's got to provide insurance to the market, and in this case, it's me. So that's that. If you want to copy the portfolio, the publicly available portfolio, you can do so. Link is in the description. Thank you very much for watching. The verdict, of course, is short. At the moment, I've actually got about 5% of assets under management in straight insurance contracts. I've also sold other types of contracts. Okay, so put options, out of the money credit spreads, the whole shebang, because I believe the company is overvalued. It's got liquidity issues. There's catalysts when management realize they can't pay their dividend. They're going to have to announce that. The market should punish them. They've been insider selling as of yesterday. And if an overall bear market occurs, then obviously that should lead to redemptions in the bigger funds that own the shares. They'll have to sell off the shares and so on and so forth. So it's not often I say this, but I hope this thing goes bankrupt. Because I think they've mismanaged it, and I think that's what should happen in a free market. So, with that being said, take care, do your own due diligence, and I look forward to seeing you in another video shortly. Take care, guys.